you got to fail to learn. So, you got to be willing to get out of your comfort zone. And that's actually how you create businesses. You learn from mistakes, and you don't have to be an entrepreneur to do that.
Hello, everybody, and welcome to the Build to Billions podcast, where we guide successful entrepreneurs and investors on their journey from millions to billions. We believe the key to scaling and compounding your wealth in life starts every single day with the mindset and practice of stewardship over ownership and applying billionaire biblical principles. Our ultimate goal is to help you scale and compound your wealth in life so you can give more or all of it away to help MVPs. My name is Brett Swarts. In each episode, we are joined by some of the world's top entrepreneurs, millionaires, and billionaires, and they share their secrets, wisdom, and insights with us so we can all level up our faith, our impact, and our life to make a bigger difference in this world. I'm excited about our next guest. He's out of the great state of Texas. He's got a really unique background. He was the CEO of Rocket Dollar, a web platform that lets people invest tax advantage retirement dollars into private alternative investments. He's a certified financial planner. He also has real estate expertise and licensing. And he recently sold Rocket Dollar to retired.com. Incredible, really cool website you want to check out for sure. We're going to be talking about Bitcoin tax strategies today. Please welcome to the show with me, Henry Yoshida. Henry, how are we doing?
Oh, we're doing great. Thank you very much. I'm glad to join you today. And it looks like it's nice weather where we both are. So Florida and Texas.
Absolutely. It's nice today before it gets too hot. And for our listeners getting to know you for the first time, would you give us a little bit more about your story and your current focus?
Sure. Ever since I graduated college, I worked in traditional finance. So I worked at Merrill Lynch, which became Bank of America. And I kind of got thrown into a division that dealt with tax advantage accounts. So that'd be your IRAs, your 401ks, 403b accounts if you're church or nonprofit or school, educational institution. And I just kind of grew up in that industry and became an expert over the years. And after I left the corporate world, I did consulting in that space, and I've since built two products, the current company, Rocket Dollar, and then I built another mobile app platform for Roth IRAs. So I guess in a way, tax-free strategies, and now just sort of tax avoidance strategies and digital platforms. So that's kind of what I've done now for the last 25 years.
Absolutely love it, right? You grew up in, you graduate college or whatever, and then you start to go into it, and all of a sudden you figure out, oh, wait, I've had the 10,000 hours in this piece of this tax code, right? These tax codes, 401k, IRAs, right? And then you look up and go, all right, maybe there's a better way to do it. So take us to the moment when you say, okay, there's got to be a better way to do this, and maybe going more to the alternatives like real estate. Although I would argue that the alternatives, according to Tony Robbins in his new book, is actually the alternatives is the stock market, right? And private equity has returned, I think, 14.5% versus 9.5% over the last 35 years. And so really it should be swapped, but maybe we could talk more about that too.
Yeah, no, I think you're right. And again, those terms like alternatives versus like, the traditional, maybe it's a little bit of a misnomer. And there's a little bit of an aside, not to do with this, but I guess in a way, if you look at me and you see me, right, I guess I'd be labeled as a minority. But a lot of times in different arenas, depending on where I'm at or where I might be, we sometimes function as the majority. So again, these are just labels. But, getting into it and realizing, I think I thought first that I never went into it thinking there was a better way to do these things or do the investments. I actually always geared it from the personality side, which was that I knew from working at a large Wall Street financial services institution that basically the sophisticated, large institutional type investors were putting upwards of 50% or more of their overall investment dollars into private and alternatives. Yet in the retail investor world, access was limited. And then even though access is getting better, now the problem is that, retail investors have a lot of their money inside of these retirement accounts. So I just decided to marry the two and saying, hey, look, the access is becoming bigger, but the access isn't going to matter if the capital that is held by retail investors can't go into it. So that's how it became the genesis of Rocket Dollar and me creating a digital version of a self-directed IRA.
Yeah, by the way, if people want to learn more right now about Henry and everything he's doing, just go to retired.com, learn how to retire with alternative assets. So I love that. And so basically it was like, hey, how do I solve the challenge of the capital flowing into alternative investments in a tax advantaged way? I call this tax flow, cash flow, and debt flow mindset and practice, right? And seeing the world of investing in what's called 3D versus just the one, maybe it's more generic. It's all about cash flow. Well, no, it's multiple things here, and they all affect one another, and we want to be aware of that. So, what just your personal philosophy before we get into Bitcoin and ways to have tax solutions with that. What has been your general personal financial philosophy as it pertains to investing?
So here's the thing. Growing up in the world of tax advantaged accounts, working for companies that largely manufactured and sold investments, I looked at it a different way. I think that the problem with most investors wasn't so much what to invest in. It was actually how they invested in these things. So let me explain here that I learned pretty early on that dollar for dollar, no matter what someone wanted to invest in. And what someone wanted to invest in was something that might be right for them. It matched their risk tolerance or their time horizon or the capital that they had, and so forth. But those same investments, dollar for dollar, if you were able to do it inside of a tax advantaged account, depending on where you live in the country, Texas and Florida may be better than other areas of the country, but you would do 20 to 40% better than holding that same investment dollar for dollar. So I started talking very early in my career to folks about a asset location strategy or like an asset placement strategy, because how and what you choose to invest in is a personal choice depending on what's available to you, what you can stomach, what you like. But how you hold that is another dimension or another level of a choice that you can make. And it's a pretty easy one for most people to make, to hold it in these types of accounts. And just by doing the same investment, you're going to do better in returns if you can avoid the taxes. So I know that, Brett, you and I both think along those lines that, hey, taxes are the killer, right? And that's something you can eliminate. You really can't control like whether that investment will perform better or worse, but you can control how you hold the investment, how you treat the investment, how you exit that investment in your case.
That's so good. I so love it, right? Asset location, asset placement, right? And it's the strategy and the structure, before you make the moves, right? So yeah, where and how are you going to invest the funds? Yeah, if you could, apples to apples, you could have them inside of an IRA, you can have them inside of a 401k, you can have them out personal tax. That's all even, that's all consistent, but how you do it is what, makes, I guess, economies go round, right? It incentivizes people to save for their retirement so that the government's not forced to have to pay for everyone in retirement, right? That's they can't force people to save, but they can tax incentivize people to do certain activities, which will stimulate also the economy because there's more investments made into companies, into growth, to hopefully creates more jobs, hopefully more tax revenue. So it goes on and on and on. So yeah, I like the way you say that 20 to 40%. How did you get to that number, 20 to 40%?
Well, just on an annual basis, depending on what you might owe in taxes, whether that's federal, state, capital gains, ordinary income, long-term capital gains, whatever that may be, it just depends. So I'm just saying that depending on the situation of how you own that investment in your own personal situation of where you're located, where you live, and the overall income that you might be reporting, that it could cost you an extra 20 to 40% more depending on where you are. And that's exactly why institutions have been successful and have been comfortable going into more private alternative type investments, because their structures allow them to, for the large majority of them, they pay no taxes and they have a very long time horizon. And for a retail investor, the closest that we come to that long time horizon, well, in IRAs and 401ks, we're forced to hold that money until we're 59 and a half or older. So for both of us, by the looks of it, that's a good 50 years away from now. I'm sure we're young guys, but you have that time horizon and you have the tax advantages. So that money is best suited on the retail investor side to go into the same types of private and alternatives that institutions have been doing. And quite frankly, as you mentioned, been using to kick our butts to the tune of 5% per year return better.
I couldn't agree with you more. And so let's keep going on this piece of it here, call it tax engineering, right? Figuring out capital gains tax, income tax, ways to be more efficient, to get more compounding effect of an extra 20 to 40%. And how you hold it and how you exit is so important. So with Bitcoin, the big thing was, well, you can just move to Puerto Rico. Well, most people don't want to move to Puerto Rico, right?
Right.
And then like, what states you're in. You might want to move to more Texas or Nevada or Florida, some of these higher lower tax states. So walk us through the best strategies that you have found with with Bitcoin and IRAs and 401ks, and now that we have a lot of these ETFs going, how does retire.com help someone who has Bitcoin or has IRAs that wants to get in and be a little more self-directed versus just go on the traditional model like a Schwab that has an ETF?
Right. And I'll delineate from what you just said right there, which is just to clarify here that there's nothing that I can do or a platform like mine at retired.com and the IRA space can do for people that currently hold Bitcoin with a low cost basis. So if you already own it outside of the account, it's not like kind. But the good thing is that right now, roughly in America, we hold roughly $33 trillion in overall retirement accounts. So if I just drill down into the IRA space alone, the IRAs typically can be controlled by the individual, but that's representing 16 to 18 trillion of the 33 current trillion dollars that are in there. And if you have monies in those accounts, you can actually transact, turn your money into cash, and then as long as you have an IRA that's capable of holding Bitcoin or crypto, which we have through our sister company, our brand at retired.com, we have Bitcoin IRA. My site is rocketdollar.com, so you can own crypto in both of those. You could trade it 24/7. But if you have IRA dollars or old 401k dollars and you put that into a new IRA at Bitcoin IRA, now you can then go in and purchase that Bitcoin and whatever it may grow to. You could do that on a tax deferred basis. The same ubiquitous rules that most people know about for an IRA. We can get into that if you want, but I can't do anything if you have it outside to then put it in. I think that's something that they need to get your book to learn a little bit more about. If you have IRA dollars that are currently in other investments, you can sell those, pay no capital gains, and redeploy into more private and alternative investments, including Bitcoin in my account.
Yeah, that's a very good delineation. Yeah. And just if you're curious, if you say, hey, well, but I got multiple millions in Bitcoin and I want to be able to diversify and defer my capital gains tax, yeah, we do have a solution here at Capital Gains Tax Solutions where you can sell, diversify, and get a promissory note back. It's via a trust. And setting this all up where you slowly pay taxes, you receive payments back. We've done this for Bitcoin, Ethereum, Chex Coin. We're actually closing another one here recently as well for different coins. And so it works for crypto or Bitcoin. But we can talk more about that here later on the show. But on yours, so yeah, if I have Tesla, Nvidia, if I have all these different S&P 500 inside of my IRA, I can sell within the IRA, right? And there's going to be no cap gains tax, no ordinary income tax, and then I can turn around and buy some Bitcoin, right? And then start to ride that up. And then 59.5 is the rule where now I got to start taking some distributions, or I can at least, right? Walk us through just those details, and then walk us through the anything else that just as kind of a reminder for those who haven't looked at the 401k or the IRAs in a while.
Yeah. So the way it works is, let's say it's 2025 today and you're 40 years old, so we'll just use a 20-year time frame. You were to purchase Bitcoin or some other private asset and you sold out of Tesla and Nvidia, which maybe you had some good gains on that as well. You create the cash, you buy the Bitcoin here in 2025. Well, in 20 years down the road, if Bitcoin is now trading at $650,000 a coin or $700,000 a coin, up from the 100,000 it is now, the good thing is after 59.5, if held in an IRA, you are able to decide how much you want to sell. So the thing is that your $100,000 account, let's say it was one Bitcoin, is now grown to $700,000. But in that particular year, 20 years from now, you actually only want to liquidate $100,000 of it for that particular year. You're only going to pay tax then on $100,000. So the rest of it can actually keep going inside of this account on a tax deferred basis, and you can continue to grow it. So that's where the powerful effects come in, because a lot of times if you own investments in a brokerage account, a lot of structured investments, so we use the example of Tesla and Nvidia, they actually charge you taxes on an annual basis. If you own a mutual fund, for example, or an ETF does tax distributions on an annual basis. But if you own it in an IRA, those just get reinvested, or you could hold them in cash, but you don't have to pay income tax on that. Only when you get to the point where you take a withdrawal, and only taxable on the amount that you actually take that withdrawal for. So you don't need to cash out all 700,000. You could just cash out 100 of your 700, pay whatever tax is owed, and let the other 600,000 continue to ride without taxes and capital.
So let's walk through that. So would it be at then capital gains tax rate in the state in which you reside, or how would it be taxed on that 100,000?
It would, so it'd be based on your situation, your personal situation, and where you reside for that year. So capital gains is actually more of like a kind of like a number that would be dictated. So you would just if you had earned income that year, 20 years from now, you made, I don't know, $200,000 in income. You want to take out 100,000 of the gains in this IRA. It's as if you made 300,000 in income that year. So you'll just have additional income. So then that depends on where you are, your overall income, and so forth. And what you owe, you're just adding that distribution to it. But it's controlled. You don't have to take all of it.
Right. And that's the key, right? And you could also have a low income year, or you move to, you move to Nevada or Florida or Puerto Rico and you're establishing residency. Then you wait one more year to take it out. Like different strategies right there that can really help. So,
or you take a year off and you're no income.
Take a year off and then just take it out. Right. That's a good point. Yeah. Lots of good strategies here. We're speaking with Henry Yoshida, and you can meet or you can learn more about him. Go to retire.com, or you can find him on LinkedIn as well. And his last name is spelled Yoshida. Okay, so now let's shift to cap gains tax as it pertains to larger exits, and even just the importance of being able to go into alternative or diversify into private equity or private debt. Different diversification, right? When you sold your company, I'm curious, did you have any extra planning that helped you to defer or to compound the wealth versus on the exit? And then the second part of that is, we'll touch on estate tax after this in here in a second, but I'm curious, what kind of planning did you do for your exit when you sold to retire.com?
So there wasn't much. It was the pretty standard, exercise the par value stock early as a founder of a company. And then just file the 83B election. So I think it's pretty standard. What people do is that they basically they exercise their stock early when it's got a very, very low value. You notify the IRS via an 83B election form that you send via certified mail, and you've basically told them that, hey, I've exercised my stock. So you don't know if or when an exit's going to happen. I've had businesses where there's been no exit, at least not from a positive dollar value standpoint. And then you're just getting the clock ticking. So you'll turn these capital gains from short term into long term, because a lot of entrepreneurs, they don't think to do that, or maybe their attorneys or their advisors don't tell them. So they start a business, then they get an opportunity to sell that business, but they haven't technically exercised their stock. So at that point, someone wants to buy your business. You're exercising the stock 5 days before the transaction closes. So clearly that's well before a year. And you're going to owe like ordinary income on the gain. So that's one way to minimize it. We didn't do anything as advanced as the trust that you talk to your clients about, but we did that standard one, and that was one of the ways that we minimized a lot.
So curious. So I was like, so getting to long-term versus short-term, and getting that year status, right? That's what you're referring to there. Did it all come fast, or did you have lots of preparation? Did you even consider looking at things? I'm always curious, like we call it building a capital gains tax exit plan, right? Yeah. It's like you spent all this time and energy, blood, sweat, and tears to build this thing up to whatever amount it was worth. And then just to see 20, 30, 40, or 50%, depending on if it was a C Corp, S Corp, LLC, and how you held and what state you're in, all this stuff, depreciation, recapture, all these different things. And I'm wondering, did you take any time to look at anything, or what was your mindset at that point?
Well, unlike retirement, okay, so I'll kind of delineate these two as well. I think that people that are heading into retirement can kind of get a general sense of when they want to plan to actually enter retirement. Right now, I'm actually, I did an interview this morning for a publication, Market Watch, talking specifically about what 2-3 things you can do if you're right about to retire, because people know when they're going to retire. The problem is you don't know when your business may exit. So I would say that we didn't do much advanced planning, because when the business got bought wasn't something that we planned for. It was something that came to us, and there wasn't necessarily time, other than the one thing that we did at the inception of that business, which was that 83B election. So we did the first step. I would say that we didn't do the more advanced ones. I think that if you're a business owner where you have this business where you've been running it yourself for, let's say, 5, 10, 15, 20 years. I think like retirement, you can also plan for the exit strategy and build that in. But in my types of businesses, it was just kind of out of the blue when someone came to acquire us.
Got it. I'm going to give a couple for those who's listening right now. So if you have at least a 5-year runway, you want to look at the QSBS up to 10 million, 5 million, 10 million. Look at, where you're at with that of tax-free money, right? If you set it and you get it all in place. Talk to your CPA. Okay. If you don't have time, or like Henry, I think 80-90% of owners who sell businesses are not expecting to sell the business, and they get an offer they can't refuse, or something changes with the partnership or life or whatever. And now they're like, okay, now I'm selling, and they don't have that runway. We do have a strategy that allows you to defer the capital gains taxes, and also another one that eliminates the estate taxes for larger exits. And there's no timing required for seasoning. So like we just closed one a couple of weeks ago. It was a 30-day escrow. I mean, they had already been on escrow. They had 30 days to close, and Denver, Colorado. Deferred all their capital gains taxes, set it all up, and so and the reason we're able to do that is we're not using a retirement account, we're not using any QSBS. You're selling it to a trust in exchange for a promissory note, and the trust is selling to the ultimate buyer. So it's just an extra step in the transaction. And that creates this deferral effect as a seller carryback, right? That's what we would know it as. And also, while it works for public stock and private stock, okay, the public stock version gets it outside the taxable estate. Kids can be the beneficiaries. Very powerful stuff. No life insurance, gifting, or insurance required, or charity required. So if anyone's listening and you're wondering, do I still have time with us? As long as the buyer hasn't removed all contingencies and you haven't, actually sold it and it's in your account, we still have time. You can set it up. Just go to capitalgainstaxers.com. Henry, before the show, I'm wondering, had you had a chance to see, you might have done some research on me, but I'm wondering, have you seen anything like what we do as far as capital gains tax planning? Have you ever explored these things in much detail, or what are your thoughts on that?
I learned about it first as it relates to selling a business on yours. I mean, I think I've seen situations where people have used trust to remove things from themselves, but not for purposes of doing it so they can make the sale. It was mostly for purposes of where they can maybe remove themselves, get themselves arm's length more than anything else. So it was kind of new to me. And again, we talked about this offline before we started doing the episode, that the irony is, for me, I've always thought about and lived in this world of account structures where just capital gains wasn't even an issue. So I'm probably a little bit dense on that because I just avoid it altogether.
Yeah, from the beginning. Yeah, you solved it from the very, very beginning until you have the big business section. You're like, oh shoot, I did so well of just helping people to avoid it from the beginning. Yeah, and so the key is you want to have a team to help you execute on all of these different things. So, okay, got it. So now let's talk back to Bitcoin. What is your take on Bitcoin right now? And even just alternative investments in general for real estate. If you had to choose, Bitcoin, investment real estate, traditional, stocks, what kind of allocation? I mean, let's assume you're worth $10 million, right? So you've got plenty of money, you have plenty of cash flow, but now you're just looking like, I got 10 million and I'm all set for retirement. I have a, medium to higher risk tolerance. But what is your mindset and your practice tell you right now? What percentages would you go into what asset class allocation?
Sure. I just wrote about this. So I did a piece for Kiplinger, and I came up with this sort of the rethinking now with the second Trump presidency and what your allocation might be. And of course, everyone's always heard of the 60-40. The irony is I don't actually know too many people personally who only have a 60-40 portfolio, and this is before maybe bond prices have dropped. But I kind of advocated for maybe looking at having something in the range of 50% in the public equities market, 15 in sort of fixed income, and this is for someone that's mid to late working, not quite in retirement yet, but also not new to investing, and decent sized portfolio, with the remaining 35% spread across all private and alternative investments. But private and alternative investments, I think people equate that term with being risky, but within that categorization of investments, there's also very stable tangible. So you mentioned real estate on one end of the spectrum. It's very tangible. I would argue more tangible today than paper-based stock or electronic-based stock in a major corporation, and then maybe cryptocurrency and digital assets in the other. So I just recommend that overall they have a 35% allocation to that. Me personally, I tend to be a little bit on the conservative side. My counterpart on the crypto side would obviously advocate for higher percentages in crypto. So I'd lean heavier towards maybe more tangible real estate because I think there's a real nice cycle opportunity today in that particular investment. But I also understand the merits of Bitcoin in that right now, with a lot of uncertainty in the markets and sort of like global currencies, and uncertainties related to the stability of those currencies, people buy Bitcoin. And because of uncertainty in the global economic environment, people buy gold. And I've talked a lot about gold. And I kind of like owning both, not because they're one's a physical and a digital version of each other, but actually they serve two different purposes. And I like both of those right now.
Okay, that's great feedback. I just did an interview with precious metals and technology metals, and part of it's gold, but all different metals and such, and a gentleman who does that, and I thought that's really fascinating. The certainty of conviction, right, is the key thing. You can sleep well at night. People that I think exit and they made their money in a certain area, whether it be a business or real estate or Bitcoin, that tends to be what they're most comfortable with because that's their experience of making the wealth. But talk about the importance of diversification just for even just the allocation that you just said. And if you had to choose diversification, liquidity, or timing, which one would you choose?
Well, so I'd probably choose the diversification because if you're just a normal investor, and let's take me as an entrepreneur out of it, let's just say that you're a normal individual who has a job and always has access to a 401k and an IRA, what ends up happening through the course of a career, if you did what you're normally prescribed, let's say 5 to 10% or 15% of your salary going into a retirement type plan, 401k, and that could be inclusive of match if the company so offers it, that you're going to end up accumulating a lot of dollars in an account that already puts you in a situation where you have a long time horizon. So I don't need to worry about the liquidity that much because you should have a component if you're even beginning a foundation of retirement savings for a non-liquid component of your investment. So you can, it's liquid in the sense that you can go from Tesla to Bitcoin back to Nvidia and then to Meta platforms and Apple. But it's not liquid in the sense that you could actually use it for consumption purposes until you're post 59 and a half. So I don't worry so much about the liquidity, but I like the diversification into the alternatives, and that alternative side is very well suited because those investments themselves may not be as liquid as your liquid public stocks. And you're just matching up the right account type with the right tax treatment and the right time horizon and the incentives, as you mentioned earlier, with the types of investments you can do. So that's why I kind of stick to that 50, 15, 35 allocation. And then the 50 may be more concentrated in the brokerages because, quite frankly, you get a lot of automatic step up too. So if you just end up holding those for the long haul, there's strategies you can do like tax loss harvesting in those accounts.
That's really good. I have one question. It's one of the things that I thought about, and the 59 and a half, the idea that retirement is basically not till 60. Retirement itself, I think, is challenged in a couple different ways where people are saying, maybe I'll never retire. I love what I'm doing. But also I'd like to have some freedom and flexibility when my kids are young, to have some passive income, to be able to not have to work so much when I don't want to work. And so that idea of like, hey, how do I replace 10, 20, 30, 40, $50,000 per month now, while I'm 25, 35, 45, even 55, I can do it by there and don't have to wait to that 59 and a half. Like, talk to us a little bit through that type of strategy. And so when someone says, I want to get an extra 10,000 now versus waiting till later per month.
Well, and that would be, you'd access those savings, the savings that aren't in those types of accounts if you needed to access it earlier than 59 and a half. And then, the flip side of what you just said too is, so for people that might be past that, maybe they don't necessarily retire at 59 and a half, but they could, I call it work optional. So I view retirement as like work optional. You could pursue work that you love. It creates an income for you. You could pursue work that you love that doesn't produce an income, but being able to have access to these accounts and managing your money is just what gives you that optionality. I mean, for years I used in interviews and talking to friends and talking in the professional circles of like, well, if you love what you're doing, you'll just keep doing it forever until you die, like Warren Buffett. And then, of course, the damn guy retired or announced his retirement this year. So now I don't know what to say when asked that question anymore. But he's in the range of about 140 to 165 billion in net worth. And decided now to retire.
Mm-hmm.
But from a money standpoint, he didn't need income prior to that. But you would
Right.
access, if you're before 59 and a half, you'd access these taxable dollars and or implement strategies, some of which you and your team could
Mm-hmm.
offer. I'm just saying that the ones in these tax advantage accounts, you have an incentive to let them roll as long as possible, because on a
Right.
year by year basis, they can compound at a higher rate dollar for dollar than owning that same investment not in that account.
Totally. No, I think that's spot on. It's a great way to say it. It's the flexibility and optionality and getting really clear with what that 5, 10, 15% or whatever you're going to be putting into these types of tax advantage accounts per year, and finding out like, okay, I know for sure I want this amount, basically saved and invested until I'm that, and that's that amount. So that's that bucket.
Right.
And then getting really clear, like, okay, and if I want to get extra passive income now, I need to invest in these kind of things. Now, what do you think about private debt? Real estate interest rates are high, so it seems like there's some good opportunity in these alternative kind of private equity debt opportunities.
So I looked at the private debt. It's interesting too, because private debt actually exists because normal traditional lending channels like banks and financial institutions view those types of opportunities as too risky to lend to. But the Wall Street Journal actually just did a nice detailed piece in the last week saying that the funny thing though is the people that actually fuel the funding for the private debt are investors who come in, but it's also supplemented by financial institutions. So financial institutions are still somewhat supporting this private debt, private credit system in America or globally right now, but they're indirectly tied. They're just one step removed. So I don't know. That gives me a little bit of pause when I think about it. But on the flip side, I do think to myself that, okay, these institutions won't do it directly, but they're confident enough to actually fund the players in the private debt space, which then gives it legitimacy to me. So I think it's just like the article actually concluded that it was a nice symbiotic cycle. And to me, as an investor or potential small investor in private credit, it actually gives me comfort that this is not something that you invest in because the big guys won't invest, the big smart guys won't invest. They just aren't doing it directly. So I love that it's actually underpinned by legitimate incumbent financial institutions. That gives
Right.
me even more confidence to say that, hey, I'll clip that extra alpha and return above and beyond
Right.
the normal lending rates and
Right.
interest,
Right.
knowing that I'm still backed technically by Bank of America, Chase, and others.
Oh, that's so well said. It makes perfect sense, and there's opportunity, right? If they were all just lending, then obviously it would get squeezed, and it wouldn't be as much return. You're right, and I think the speed of which the capital returns as well. How long do you have to lock it up for? Is it 30, 60, 90 day semi-liquid? Is it 2-year commitment? Are you getting quarterly paid back to you, and looking at the speed of the return of the capital, right? And obviously their track record and do they have reserves? Have they ever lost a dollar? And obviously, what are they doing it in? What is the debt going towards? And can you get certainty of conviction for that? I really like private debt that's going into real estate that has to do with the housing crisis, right? And the supply demand imbalance of 5 to 7 million units short, maybe even higher than that. And so we've been having some real success with anything that had to do with like the housing market. Do you sense any big headwinds with the housing market? What is your feel for like, any kind of change here in the next 6 to 12 months or 24 months with real estate in general?
Well, right now, real estate is somewhat locked up, but it's actually the issue you just mentioned is that there's not enough supply of new housing, but then the problem is existing housing too. So right now, new home sales seasonally adjusted for the rest of the year are tracking towards 4 million. The last few years, it's been in the 5 to 5.5 million of homes sold. And the reason why they're not selling is not because the potential buyers can't afford to buy it due to high interest rates. It's because the people who hold the real estate it doesn't pencil out for them to try to get into a new property, because at a higher rate, they have a low basis, they have a locked in low interest rate. So even if they wanted to downsize or upsize, the cost of getting into a new place is too much, so they sit still. So the lockup is actually happening from the existing holders of real estate, at least on the U.S. side.
Yeah.
And that's going to continue to cause like price discrepancies that investors can take advantage of right now. But I don't see it getting better as an overall industry in the next 6 to 12 months. But I think that if you're savvy or you invest in someone who is savvy, which is what you talked about, supply these private debt providers in the real estate space with the capital they need to go do the deals and let them go find those opportunities for you. Because the environment, all the data is going to show that it sucks, but that actually means that there's great opportunities to be had. And it's not because people don't want to buy. It's because actually the holders don't want to sell right now.
You nailed it. I couldn't agree with you more. Henry Yoshida, everybody. You can learn more about him by going to retire.com. Anything last thing you want to say about Bitcoin or capital gains tax or anything else before we move to the lightning round?
So I think right now I'd say that hey, the uncertainty and the political environment are actually very positive for a lot of these private and alternative investments. The legislature regulations are, I wouldn't say getting relaxed, but they're more friendly and open to opportunities in Bitcoin, in gold, in private investments, and so forth. And that could bode well for your portfolio. So it might be time to really start to rethink that 60-40 and look at a 15-50-35 split.
Yeah.
Into alternatives.
Yeah. Could agree with you more. That being said, ready for the lightning round?
I don't know. Let's see.
Knowing what you know now, Henry, if you go back to your 20-year-old self, what's one golden nugget make sure to tell yourself to do?
I'm trying to, I'd probably tell myself to like eat better, drink less, and like read more.
There it is. Question number 2. What's your number 1 book you've recommended or gifted the most in the past year?
In the last year, and this normally wouldn't be my thing, but I really enjoyed, she's very popular right now, but Mel Robbins is Let Them. It just kind of made me think about, it solidified for me. We've always known it as, I think, hard charging, more male types, but just not caring what other people think about you. But that book really like codified, like that's a way of life. And I really need to get better at that.
Awesome. I'll check it out. Question number 3. What are you most curious about right now?
I'm trying to get a little bit better. I have a 14-year-old daughter, so I have 2 daughters. My oldest one is 14. So I am trying to learn a little bit more about what is relevant in her world. Like the generations, we might be one generation apart, but because of technology and the digital world we live in, it feels like we're 5 generations apart right now. So I'm trying to get a little bit smart on what the cool kids do.
There it is. I got a 14-year-old daughter too. Maybe we can share notes.
We'd probably be the worst people to share notes with each other.
I'm doing jiu-jitsu with all my kids right now. I got 5 of them. And so that's a cool thing that we relate to. I'll take them to the class, I'll be rolling, they'll be rolling. And after we get done, we meet together and we share moves and, how we did and the successes and the struggles and stuff. So just a tip, that might be a good one for everyone out there. Next one is number 1 leadership quote or theme that you strive to live by.
So I'm trying to think. That's a tough one. So I don't know if I have a good quote like off the top of my head. It's just
it could be a theme too. It could be a theme. It doesn't have to be a quote, but a theme.
For theme, and I just talked about this. I was a guest on another show, and we did it from like this big metals depository. But I think it was just that you got to fail to learn. So you got to be willing to get out of your comfort zone. And that's actually how you create businesses. You learn from mistakes, and you don't have to be an entrepreneur to do that. You can do that inside of your normal corporate type career job as well. But you just have to be willing to take the losses to be able to move forward. I think that's important. Be comfortable.
Yeah, 100%. I love it. Last question, Henry, and then we'll wrap it up. What's the best way that you stay centered in your values and stay encouraged to charge forward to reach even higher heights?
For me, I look a lot at my family. I always think to myself that I just want to carry myself in a way, both publicly, privately, when no one's looking, in a way to where if my children were able to see all of it, that they'd be proud of who I am and how I carry myself and my beliefs, my principles. And that's important to me. And I think that's what drives me both in work and obviously in my home life as well.
Henry Yoshida, it's been more than a pleasure having the show. It's been an honor to have you on the show. I want to just thank you for sharing your wisdom with us, sharing your heart for helping people create and preserve wealth in an efficient tax way. Congratulations on your sale to retire.com. And also, you're not stopping. You keep building it, helping people to build wealth. For our listeners who want to get in touch with you, could you remind them one last time what's the best place for them to find you?
So they can find us at retired.com. And again, we have customers all over the country. We have $12 billion in customer assets. So we have a lot of people working with us to be able to solve that asset location problem using their IRA dollars to do private and alternative investments. that's what we do. That's what we're
Awesome.
all about.
Perfect. Thanks, Henry. I also want to thank all of our listeners for listening to another episode of the Build It to Billions podcast. We're also streaming on the Capital Gains Tax Solutions podcast. Hey, we're here on this journey with you to scale from millions to billions so we can give more, all of it away to help MVPs. I'm going to encourage you today to take action, to be very clear on where each dollar is going and the efficiency within the tax flow world that we talked about today. Of course, if you have a big exit coming up, massive capital gains taxes with Bitcoin, business, stock, real estate, you want to go to capitalgainstaxers.com to get started with a no-cost consultation on how to exit in a way that helps you to compound your wealth. As well, please share this with somebody. Rate, review, subscribe. Appreciate all of the love and support out there, and we'll talk to you all real soon. Bye now.